Nigeria's headline inflation rate for February is expected to slow by 20.96%, and that's according to projections from financial derivatives company FDC. To talk more about this, we have Dr. Desola Simoni, senior analyst at FDC. Good morning, Desola. Great to have you.
Good morning, Ladi, and thank you for having me on the show.
So this projection obviously doing my head in, because I know February was very challenging. And with the whole cash scarcity, people having to pay for cash, the fuel queues still there, and you guys are expecting a drop for inflation. How's that going to happen?
Thank you. So, like you said, the National Bureau of Statistics is expected to release the February inflation numbers March next week, on 15th of March next week, which is next week. And we forecast that inflation will actually decline by 0.8% to 20.96%. And this is driven by a host of factors. Number one is base year effect. So because of the comparing the CPI with February last year, which was also high, we expect that would support a decline in inflation. On the second hand, we've also seen a relatively stable exchange rate because, exchange rate, given that Nigeria depends heavily on imports, so exchange rate pass-through effect has a strong impact on inflation numbers. So we expect, because the inflation numbers, because exchange rate has been relatively stable at the parallel market in February, it was stable at around 752 naira to the dollar. At the investor and exporters window, it was also relatively stable at about 460 naira to the dollar. So those two main factors are why we predict a decline in inflation. In addition to that, like you mentioned, Ladi, we've seen cash shortage in the country, which kind of slowed down economic activity. So that also contributed to the decline in inflation. In addition to that, also, although we saw fuel queues, partly due to cash crunch, the price of fuel has actually declined by around 59%. So all of these factors are why we predict a decline in headline inflation. In addition, Ladi, we are also forecasting a decline in core inflation by 1.1% and a decline in food inflation by 0.08%. However, Ladi, on a month-to-month basis, inflation increasing slightly on a month-to-month basis by 0.08%, which suggests that the inflationary pressure still persists, and this is something that the Monetary Policy Committee will have to consider clearly at their meeting later this month.
And talking about the MPC, we know globally central bankers still trying to rein in inflation at this time. And we know that the CBN here, they've been quite busy, trying to mop up all that cash, outside the banks. Are you expecting more rate hikes, at the next meeting?
I think at this meeting, we expect the central bank to hold all monetary policy factors unchanged, because one, we are going through like a precarious moment with the elections and change of administration. In addition to that, there's still this challenge of not enough actual cash in circulation, even though we've seen an increase in cash in the banking system, which suggests that maybe monetary policy would be more effective. But in terms of economic activity, I think at the moment, the central bank is trying to look at the pass-through effect of the previous rate hikes in January. So I think at this moment, the optimal option is to maintain all monetary policy parameters unchanged.
All right, going outside our shores now, we know the U.S. Fed chair is hinting at raising rates even more, and we're seeing that play out in the oil market, with prices dropping earlier this week about $3 and risk assets, being hit hard at this time. It looks like it's going to be a weekly loss for the oil market and risk assets like equities, global equities.
Indeed, Larry. So, like you mentioned, I think the key takeaways, or the key takeaway from the U.S. Fed's testimony in front of Congress is higher and faster. Essentially, U.S. Fed Chair Jay Powell mentioned that the U.S. Fed is ready if all the incoming data suggests the need to increase rates at a bigger size and quicker, that they are willing to do that. And like you mentioned, that hawkish tone, took a toll on the market. We saw S&P 500 in New York go down, close at 1.5% lower on Tuesday. We saw NASDAQ down 1.25% also on Tuesday. We saw the US two-year Treasury bills, which kind of tracks market expectation, also rise. The yield on that rise to like the highest we've seen since 2007 at around 5%. We saw the US dollar also strengthen against a basket of currencies, which had a strong effect on US dollar denominated commodities like oil. We saw oil also decline. We saw gold decline. So because of expectations of this higher pace or higher size increase in benchmark interest rates, I think it also suggests that the US Fed, also the ECB, are trying to slow down economic activity, which is going to slow down the demand for oil, and that's part of why we're also seeing oil prices trend downwards at this time.
So at this point, is it for sure that we're going to get that global recession, with the way the central bankers are looking super hawkish at this point?
And I think, Gladys, it's the corridor of which the central bankers, global central bankers, can kind of slow down, bring down inflation while still kind of escaping a recession is getting narrower, right? So with last year, for example, we saw the fastest pace of increase in of tightening in the US globally, the fastest we've seen in around 40 years. And we expected that should kind of cool down the global economy, but we are not seeing that, Laddie. At least for January numbers, we saw inflation still remain sticky. And for a country, where the long-run inflation target is around 2%, with inflation levels being at 6.4%, is giving them sleepless nights. We also seen a strong job market in January. The numbers for new vacancies and new jobs in the US came in bigger than expected, and that also spooked the central bankers. And that is why Jay Powell, at his testimony earlier this week, suggested that previously he had forecasted that benchmark interest is going to peak at around 5.1% at this year, but now we are expecting that would increase even for the meeting for the US Fed meeting later this month, which previously there were expectations of a 0.25 percentage point increase in benchmark interest rate. I think now markets, they are now stronger bets and bigger bets for a 50 basis points increase.
And obviously, the markets are already reacting to all of this. And we know the U.S. Fed chair, he's been trying to, let the market know that we're going to go harder with this interest rate hikes. Don't get too excited. We know how the markets rallied in the first part when 2023 started. But it looks like all of that is gradually coming to an end, at this point. But do you think those investors that are willing to bet on, some kind of recovery in these markets, do you think they have a chance in 2023 to see a bull market in the global equities market?
I think at this point it's quite so let me say this, that we're expecting the US Fed chair said, it depends on what the data says. So they're trying to follow a data-driven approach, right? So at this point, I think there's a lot of uncertainty. And even though yesterday, on Tuesday, the US Fed said, they're willing to go hawkish, if the job numbers come in softer tomorrow and inflation numbers for the US next week, I think on the 15th of March, if it comes in softer than expected, then we may not see that, and if it persists, then we may not see that. So I think it's quite tricky, but I think it is possible that we may still see a bull market towards the end of this year. But I mean,
that US job market still very resilient at this point. Let's look at cocoa prices now. We see they've rose about 0.43%. What's driving that?
Mainly cocoa at this moment is tightness of supply from Ivory Coast. So Ivory Coast is the biggest producer of cocoa globally, and over the weekend the exports the exports at the Ivory Coast ports came in lower, about 1.7% lower, to 1.72 million metric tons compared to the same period last year. Also in Nigeria, the Cocoa Association of Nigeria forecast For January, cocoa exports was also down around 5.5%, 5.9% year on year to 43,000 metric tons. So we are seeing some tightness of supply in cocoa coming out of West Africa, and those are the key factors are driving cocoa prices at this time.
And looking at domestic commodity prices now on your slide, there, we see a 50 kg bag of Gary roast about 20K. And price of bag of onions, that's going in the opposite direction. That's dropping. What's driving sentiment in that market?
So for the domestic commodities market, I think the biggest factor driving it now is the cash crunch in Nigeria, right? For perishable goods, we are seeing, because of the cash crunch, many transactions could not, we are seeing a slowdown in economic activity. Many transactions could not hold down. For perishables, we are seeing the price of those commodities decline quicker, so that, these sellers are able to sell these commodities before they go bad. In addition to that, Ladi, we're also seeing, a kind of slowdown in economic activity, slightly preceding the election and also slightly following the election because of a risk of electoral violence. So we saw like a slowdown in economic activity, a slowdown in transportation of some of these commodities from where they are produced down south, and that kind of reduced the supply. For instance, for Gary, reduced the supply available in the southern parts of Nigeria. Because of Gary has a longer shelf life, we are seeing the price remain quite sticky upwards.
So I guess the dry foods sellers, they're going to do better in this market at this time.
Indeed.
All
right. Ladi.
Thank you so much, Dr. Desola Simoni, Senior Analyst, Financial Derivatives Company. It was great having your perspective today. Thank you.
Thank you very much.